All right, welcome everybody. Good afternoon. Thanks for coming. All right, so we're going to talk about trading double calendars in 2018. This is for educational purposes today. So this is a new class that we'll be doing, and I'll talk about it. I'll just go through some logistics, then I'll talk about why I'm doing this class, and we'll talk about a few things, and then we'll get going. So this new class that will be on double calendars, it will be a 3-week class. We did a very basic class that was on double calendars. We called it a double barrel calendar over a year ago. It was very basic, introductory. We really weren't trading many double calendars, and that was just 2 weeks. This is 3 weeks. It will be quite different. The preview class is today. It'll be starting a week from Tuesday, Feb 13, the first class. There'll be 6 classes total, Feb 13, 15, 20, 22, 27, and March 1st. This will be a 3-week class starting Feb 13. 3 weeks, the class, it'll cost $297. It'll be 6 to 9 hours of live content. Each class, they'll meet Tuesdays and Thursdays at 11 a.m. Central. The reason I'm doing the class at 11 a.m. versus 1 is because since there'll be a decent amount of shorter term trades here, we'll be putting live trades on every class. For these shorter term trades, I'd rather execute them earlier in the day than later. That's the main reason. If a lot of you have trouble with the 11 a.m. Central, let me know. If you're interested in the class and that time doesn't work, but that's why I'm doing it at 11 a.m. Each class will be a minimum 1 hour. Most of the time I go over that. Every class will be live trades to illustrate it, and we'll follow those through the entire way. All classes are recorded and archived, and the nice thing is always with our online classes, there's a class page that you'll be able to watch the archived videos months and months after the class, and you can ask questions anytime during or after the class, and they'll come to me. So as you're reviewing the material, even if you can only watch a few of these live and you get them recorded, no problem. You go home, you watch it, you throw the questions in, and we're happy to help you. Now, let me just get in real quick, and I'll talk class agenda, but why am I doing a class on double calendars? There's a couple reasons. Over the last 4 or 5 months in our community, Sheridan community, by far, it's been the most successful strategy. Most of that time, except for the last week, we've been between 9 and 11, and the volatilities, they're a little higher. Today, they're about 12.5. Over the last few days, they got up to 14, but that's not a big hindrance on these things, the fact that the vol's up a little bit. But they've been the most successful strategy by far, blown the doors off our other trades, the butterflies and all that kind of stuff, most of that. And so that's why I wanted to share, this is kind of an iron condor alternative, and it's been a very effective trade, and we've been doing it for 5 months very regularly. So I thought that would be good to share with you guys the trade, and that's why I purposely made this class 3 weeks. So we get a lot of time for putting on the live trades and interacting, how to do it. And, we've been doing this for every week for the last 5 months, and it's been working well. So that's what I wanted to focus on this, because I thought, if something's working and really doing well, I think it's important to share it with you, right? So here's a rough class agenda. Again, like at any class agenda, it can be changing, but I just give you this very general at this point. Every class I do, even if I did a similar class, which I didn't, a year or two ago, I do this from scratch. So it's, the double calendar class will be much different because of length, because of we've been doing it versus we weren't really doing double calendars when I did the last class over a year ago. So class agenda, first class will be the Greeks and trade setup with double calendars. How do you want the Greeks at the beginning of the trade? Where do you want to position the strikes depending on the duration, Class number 2 will get into the risk management, the 4-step risk management plan and adjustments. Class number 3 will be showing them in different vehicles, double calendars. Number 4, Mark Fenton, who works with me, will be teaching class number. So it's good to get a different perspective. I might bring Jay Bailey, see if his schedule to do one of these, because I think it's really important. Mark and Jay are excellent traders to get their perspective on it. It's good to hear from different voices. Class number 5, trading double calendars in different volatility environments. And then class number 6, okay, now that we've been through all this, let's make a plan. You know, and I'm just use this here, plan to make $3 grand a month with double calendars. You can put in whatever number you want there. It could be 200 a month, it could be 10,000 a month. But I'll go over a plan that I like for doing that. Robert says, will this be all short-term trades? Most of them will, but I will be talking about even some longer term. But this will be, the primary focus will be on the double calendars. My short option will be either, 8 to 11 days, 8 to 16 days from expiration. That'd be probably as far as the short option, that will be the predominant trade, but I will look into I will definitely be going through some longer term double calendars so you understand them and the differences and when you would apply them. But the ones that have been working in our community effectively for the last 4 or 5 months would be the shorter term double calendars, where your short options will either have 8 to 16 days before they expire. That'll be the predominant one. Those have been working really good, but I'll cover some longer ones. All right. So let's jump in and go over a few double calendar examples to let you see what we're talking about. Here's SPX at 28.24. When I looked at this about, I don't know, maybe a couple hours ago. And if you look at this, as you can see, in the world of income trading, kind of what would you call it? Income trading is more positive theta options, where the options you're selling are decaying quicker than ones you're buying. So you're bringing in more decay on the ones you're selling versus the ones you're buying. And let me just, why is this not helping me? I'm trying to get okay, here we go. So let's look at 2017. Let's get a little bit of perspective. If you look at probably from end of February through middle of September, this was, to me, income trading paradise, right? For the most part. That very slow upward trending, we probably had a 200-point range in SPX, basically between end of Feb, beginning of September. That's about 7 months. And so in this type of thing, especially with trades that have maybe some risk in both directions, this is easy. And I'd say the majority of our students, it was just like, it was pretty easy, right? They did well. When you started to get into September, right, what happened is, as you get into the last quarter of the year, you had a couple things going on that made it tough for trades that, short Vega trades like butterflies and iron condors. What made it tough is 2 things. Number one, VIX stayed under, VIX was between 9 and 10 for probably the longest length of time in the history of civilization. So as we went into this last quarter of the year, VIX stayed really low. But the other thing that really made things difficult is as you look here, as you're starting to get into September, the speed, right? You're basically up 2-3 months. What took 7 months to move 200 points, you basically did it in a couple months. So that really low volatility and the speed to the upside made a bigger obstacle. And then what you had for this year is very interesting. if you look at, we've had about 22, and we'll get to this in a second, 22 trading days of the year, and half of them have been about 18 points in the SPX. So we've had tremendous speed. And when we get, I'm going to go show you a little bit more here. Let me just make a comment. If you look at VIX, you can see what I was saying here is you get September, even here, if you look at, I made a line at 10 in the VIX, and you can see here quite a bit of time, right, that we were under 10 for that last quarter of the year, and that, I think, made it difficult. SPX Speed this year, we've had 22 trading days this year, including today, and you could see starting January 2nd, if you want to look at about a 1.5 standard deviation move, which is close to, depending on the volatility, 18 points or more, but you could see out of 22 trading days, how many days that we moved 18 points or more was about half, right? And as I said before, during this period of time, I would say over and over again in teaching sessions during the day, when you start seeing speed pick up, where you're getting, 2-3 days a week, moving almost a standard deviation and a half, it's usually a precursor to more volatility, and that's what we got. If you look at Friday, Monday, and Tuesday, those 3 days, we had the most volatile on a close-to-close basis, volatile 3 days, in probably a year or two. You agree? Friday was up 33 points, Monday was down 19, and Tuesday was down 31. So finally, the speed that we've been getting to the upside is starting to translate to the downside. So to me, we've been preaching on this for the last 3 weeks in some of our sessions that, it's like a volcano ready to erupt. It's usually a precursor of more volatility. And so, there's certain precautions and different things you'd want to take. So that's what I put. 10 days out of 22, SPX moved 18 points. A 1-day standard deviation today, if you take an at-the-money 25-day call or put of 10 volatility, would get you about 14 points. So it's concerning when we're getting this kind of speed, and this is the type of pattern I saw in 2008 when things collapsed. Am I looking at things collapsing? No, I hope I'm wrong. But usually when you get this kind of speed, as I've talked about today, you want to be more careful in your trading. You want to keep your Greeks a little more under control. You want to use certain types of adjustments, et cetera, et cetera. All right, so let's move into, here's been, one of the type of calendar, double calendar I've been doing. There's kind of two favorites in our community that we've been looking at. But one of them is a 22 versus an 8-day. And this would be, if you're putting it on Thursday for today, our short option will be a week from Friday. So we're buying we're selling the Feb 9 expiration, right? You're selling the Feb 9 expiration. That expires a week from tomorrow. And then you're buying an expiration 14 days past the one I'm selling. And in this case, in this particular trade, I'm starting with SPX at 28.22. The green line would be your expiration graph. Your red line, which is more steep, you can see that, or purple, depending on how you're seeing it, is your graph of how it looks today, right? So for this trade, looking at today. So you could see it expire, it's kind of like an iron condor look, right? With the underline right here, I'm doing a calendar at the 28.50 strike, which is about 28 points up, and I'm doing one on the 27.90 strike, about 30 points down. So it's got kind of that width of it like an iron condor. I'm buying 128.50 call in this expiration, and I'm selling 28.50 in this expiration. And the puts, I'm buying the 27.90 puts, selling the 27.90 puts, buying the Feb 23, selling the Feb 9. One contract in the SPX is costing me $19.70 debit, about $1,970. And that's that trade. You know, could you do it cheaper doing it in SPY in terms of dollar amount? Yeah, but you also could do it cheaper if my long expiration, instead of being 14 days past my short, if it was 7 days past my short. But that's fine. This is fine. Now, generally over the last 5 months, this type of trade, I'd say 70% of the time I get out of it in 1 or 2 days and make my profit. The other 30% of the time, you'd have to make one adjustment at the most or get out. And that's kind of the life of this. VIX was about 1367 when I looked at this today. Obviously, it's lower today, right? Isn't VIX like 12.5 now? But this is the trade. The Greeks, I'm a little bit delta long when I'm starting. Nice, beautiful, positive theta. Lots of positive theta. And my Vega is 226. So even 2 days of theta, which would be about $130, 2 days of theta is about 6.5% yield on the capital in the trade. So this would be an example of a 22 versus an 8-day, thank you, Robert, double calendar. Another version we do would be, some people would go a little bit further out, 29 versus 15. So instead of my short options being 8 days out, they'd be 15. So if today's Thursday, I'm going to sell options at the Feb 16 expiration, which would be 2 weeks from tomorrow, and buy my long options about 14 days out. And you can see here, it's just, you know, what's the difference? I can get a little further away. Now my short strikes are 28.60 versus 28.50 before, and 27.80 versus 27.90. So a little bit farther out of the money. Doing we'd call this a 15-day calendar. And you can see the Greeks, I'm a little bit long here. There's some nice positive theta, but not as much as in the previous shorter term trade and long Vegas. Again, these are more of an iron condor alternative. And then, as I said, we'll talk some longer term. Here's a different one, right? And this would be a longer term double calendar. My long is 64 days out. My short is 32. And we'll go through that during the class. When would I do the different expirations? And when would I do a 10-day? When would I do a 15-day? When would I do a 30-day? And then how much distance do I want between my longs and my shorts? So here's my long is 64 days. My short's 32 days. So my shorts are going to be in a March 5 expiration. My longs are going to be in an April 6 expiration. With the underlying at 28.22, I'm buying 128.60. 38 points up, April 6 call, and then I'm selling a 28.60 March 5 call. On the puts, I'm buying a 27.80 put, April 6 expiration, and I'm selling a 27.80 put in the March 5 expiration. The cost would be $33 on this one, more expensive because we're going 32 days between my long and my short. And you can see here, my Vega is going to be more than the shorter term trades, but my theta will be more dismal, right? Versus some of the big fat thetas of the shorter term trades. But again, here's the expiration graph on this with the current price of 28.22. So it's got that kind of wide iron condor feel to it. A question says, why 14 days and not 12 or 11? You could do a 12 or 11. I've just been doing this for a while, and a lot of the reason, Petra, is we have a trading group that meets on Thursdays in Sheridan Mentoring. So we meet on Thursdays, and that's when we put the live trades on together. So it's just been really getting used to doing that, putting it on Thursday for either a week from the next day, Friday expiration, or 2 weeks from that. But could you do it 12 or 11 days? You could. Just be consistent. Yeah, like Dino said, like today. And then here's an example of a double calendar. I'll also talk during the class about doing some double calendars in stocks. Now, this looks a little too good today. Part of the reason is Apple's earnings are coming out after the close today, right? And so would I normally do this going into earnings, like in other words, going into earnings, meaning keeping it on for the close tonight and taking the wrath of the move? No, unless I had an opinion. But let's talk about this. So here'd be an example. I'm buying the Apple's was around 167 when I looked at this. By 1 March 16, 175 call. Yeah, Melanie says, so you trade these yourself, do you? Yes, I do. And we're, in our trading group, we probably got 50 people or 30 people doing this. We got a lot of people here doing this, yes. And during the class that we have, the live class, we'll be putting on live trades every class. So you can see every step of it. Total transparency, which is good. So here is the double calendar. I'm setting the call side up at 175, the put side up at 160, and we're at 167. So here I'm buying 175 call, and I'm selling 175 call. My longs would be in the March 16. My shorts would be in the Feb 23. And then on the put side, I'm buying the 160 puts in March, and I'm selling the 160 puts in February. And it'd be about a 210 debit, so you're about 8 points up. It normally wouldn't look this good. Part of it is just because with earnings coming, it's looking better. But the whole play with this earnings tonight is, what's the expectations? Apple Apple has a history of moving, 5 to 7%. So if you take $167 stock times 5% would be 8 points. The only way I would put this on tonight to go through earnings is if I felt, hey, you know what? I think we're going to be between 160 and 70 and 175 with the move tonight, I'd do it. So whether you put a double calendar on tonight with earnings coming up is strictly based on, what do you expect earnings to do? And so generally, this would be more of a spec trade if I put Apple calendar on tonight, because you've got this gap move coming and you can't adjust until it opens tomorrow. So I would generally put on a double calendar. I would stay away from earnings. The only way I would put a double calendar or an iron condor or something on for earnings is that's a little different bet. If I'm expecting, my expectations of the move would be less than, in other words, if I'm expecting the move, if Apple moves 5% historically for earnings or 6%, and I expect it to move less than 5%, then I would put a trade like this on. You see that? But we will be talking about double calendars during the class. All right, another question said, how are you selecting the strikes? Are you using deltas to do this? Not really. Part of, I think as you get narrower, as your expiration gets narrower, as you do a 9-day versus a 15 or a 15-day versus a 28, you're going to be narrower as you get closer. Generally the deltas will be somewhere between 22 and 30 for the short options, but it depends on the duration, and that's what we'll kind of teach you how we, what width we do, but ultimately the width is determined by the Greeks, how I want to structure the deltas at the beginning of the trade. So I'm selecting the strikes by a combination of the duration and the beginning deltas, but will be the two main factors, but generally it'll be between a 22 and 30 delta. And I'd say just my experience on these, and I think anybody else doing double calendars that's from Sheridan Mentoring that's in here, over the last 5 months of doing these, I'd say 70% of the time, you know, you're out in 1 or 2 days with your profit target. But again, here's the key. I don't know what the next 3 weeks holds, but the key is you learn to trade. This is a craft. This isn't a get-rich-quick scheme. You know, we do these, you know, live weekly in Sheridan Mentoring among many other strategies, but it's learning the craft, right? And I think the mentality is if you want to take a class that'll be extremely practical, that'll teach you from folk that are doing this stuff how to do it, it'll be a really good class for you versus a lot of theory and a lot of just talking about it. You know, you're going to get all the logistics of it. The max loss on these generally around 10%, but it depends on the duration, it depends on the trade, it depends on the profit target. So anyways, if you have any more questions, you can email me, dan@SheridanMentoring.com. I'd be happy to help you. Again, we start the class a week from next Tuesday, and it'll go 3 weeks, Tuesdays and Thursdays at 11 Central. And you could, you know, you could sign up anytime on the front page. We trade SPX a lot, but again, here's the key: we're never in these anywhere near expiration. You know, we don't trade like that, so we don't even have to worry about that. And so, anyways, thanks everybody. Have a great day, and we'll talk to you later. Thanks.